Good morning. My name is Eugene Cook, and it is my pleasure and privilege to introduce to you John Gray, President and Chief Operating Officer of the Blackstone Group. He now leads Blackstone as the world's largest asset manager with over $1 trillion of AUM. John is a terrific leader who emits perpetual positive energy, and he deeply believes that kindness is a key recipe to success. John, welcome back to Korea, and thank you for being with us.
Thank you, Eugene. That was a lovely introduction. Thank you all. It is great to be here. Congrats to the Mail on this amazing event, the World Knowledge Forum.
Well, John, I think let's just dive right into this. I think there are many people in the audience today who are extremely curious to hear from you about a number of topics, but to start, what is the state of the global economy, and where do you think it's headed?
So we're going to start with a small topic. What I would say is we're really in a period of transition. If you think about it, we had pretty strong growth. Obviously, we had inflation, and central banks around the world responded by raising rates pretty significantly, shrinking their balance sheets, and we're now beginning to see some deceleration in the economy, and certainly inflation coming down, and we're going to begin to see central banks ease. And if you just dig deeper in this, what I'd say is when we look at our portfolio companies, we've still seen pretty good resilience. In the second quarter, earnings growth in our companies, or revenue growth, I should say, was mid-single digits. We had very low levels of defaults in our several thousand non-investment grade borrowers, so that's a pretty good sign. But we have seen revenue trending down a bit. We've seen hiring at our companies become much more constrained. And I'd say we're seeing weakness in the consumer side of the economy. So water parks and theme parks and hotels and consumer goods. And, it's a gradual deceleration. And by the way, it's a similar story pretty much around the globe. Probably a little bit slower in Europe, but it's a similar story. On the inflation side, back to my earlier comments, that is positive. We've definitely seen input costs flatten out. Rental housing costs have moderated quite a bit. And wages, when we survey our companies, they say a year out, they think it'll be 3% growth. So sort of back to normalized levels. So if you think about it, central banks, particularly in the US, have a dual mandate: price stability, fighting inflation, and employment. And they've been quite successful here on the price stability front. And they're now beginning to see labor markets soften. And I think what we're going to see is them responding by cutting rates. And hopefully in doing that, this deceleration we see can be gradual, this soft landing people are hoping for. So interestingly for us as investors, what we've been trying to do is deploy capital a bit before this, because people generally have been waiting for rates to come down. But when that happens, that can help lift up asset prices. And we've been trying to get ahead of that. But our overall picture would be one of decelerating growth, decelerating inflation, central banks responding by easing policy. That's what we see today.
Great. And in response to that, in addition to Blackstone, do you see the overall global deal-making environment improving or responding to that? Or is it just really isolated to a few select?
No, we definitely see it. Again, if you go back over time, the deal business is cyclical, and there have been other periods of sharp downturns in transaction activity, M&A. So if you went back to the early 90s, we had a 50-60% decline. After the global financial crisis, we experienced that. And that's really what happened in 22 and 23. But eventually something changes, and I describe it like flotation devices below the water. They've got to come to the surface, A family needs liquidity. A company needs to sell a non-core division. A private equity firm wants to sell. And the conditions change. And in this case, the changing conditions go back to my earlier comments, which is central banks easing. Borrowing costs are coming down. Both base rates, short-term rates. I think here in Korea, there'll be cuts coming as well over time. Long-term rates coming down. And then spreads coming down. And then that helps facilitate transaction flow. And if you look this year, you've begun to see signs of that. Certainly at our firm, the second quarter, we committed or invested $50 billion, which was the busiest in the last couple of years. We just announced our biggest deal ever in Asia last week in AirTrunk, the largest data center company in Asia. We have been picking up, and we're seeing that across our firm. But it's gradual. It's not rocketing back. The IPO market is still slow. But I would bet that would come back. And so there's a cyclical element. It feels like the conditions are improving for transactions. I definitely think 25 will be a better year.
And in that environment, John, where are you finding the most compelling, exciting opportunities, whether that be geographic or sector-wise?
Well, I'd say a few things. One is we really like private credit, lending to companies, real estate, infrastructure. Part of that is because interest rates have been elevated, spreads have been elevated, so you get paid a fair amount for taking low risk. But part of it also is structural in nature, which is if we bring our investors, pension funds or individual investors, up directly to borrowers, you eliminate a lot of the financing securitization costs. And so I just think that is a sector that has some long-term secular tailwinds, private credit. So that's an area we like a lot. I would say the recovery in commercial real estate, that's an area, of course, which has gotten very beaten up as interest rates went up. And of course, back to my comments, cost of capital is coming down. The fundamentals in that sector are going to improve with less supply. So that's an area we're spending a lot of time in. Geographically, India is probably the market. We've been spending the most time outside the US. Lots of good things happening there on the manufacturing front, domestic consumption. We're quite active there in both private equity and real estate. And then I would say thematically, and this really applies around the world, there are some sectors we really like. So certainly digital infrastructure, data centers, which really are the physical manifestation of what you're seeing in AI, but also cloud migration, data storage. It's the superhighway of the 21st century, and so we have been the most active player in that. We own something like 50 billion of data centers that we own or under construction. We have another 70 billion that could potentially be developed over time we're working on, and then we just did AirTrunk. So I would say that's an area that we have huge enthusiasm for. I would say the power that's tied to that is another interesting area, and we love to be thematic. Think about areas where there are big long-term changes going on, and you know, in most of the developed world, power usage has been pretty flat the last 20 years. And now a bit of electrification from vehicles, some reshoring in developed markets, but particularly data centers is causing a surge in power. So building renewable assets, generation assets, transmission, and all sorts of services. Life sciences is another sector we love, which is benefiting from big data coming together with genomics and the advances there. We're constantly looking for our alternative space, the business you and I are in, in buying stakes in other managers, secondaries in funds, lending to private equity firms. I think one of the things investors do, they get so caught up on near-term things, what's going to happen in this election, or will the Fed or the Korean Central Bank cut rates this quarter? I love to step back and think about the bigger picture and say, there's a structural shortage of housing around the world in developed markets that's been building since the financial crisis. Commerce is increasingly moving online, and how can I play that derivatively with logistics? And you find these big thematic areas, and then for us, express it in private equity, real estate, infrastructure, growth, credit. And I think that's one of the reasons we've been able to outperform over time.
John, just to double click on the topic of AirTrunk, which is obviously a massive transaction, possibly our largest investment that we've made in Asia. Obviously, there's a tremendous amount of conviction that you and our firm feel about the future of digital infrastructure. How do you think that plays throughout Asia? Because obviously, Korea, China, Japan, India, these are all very large markets that ultimately will consume a lot of the demand for this.
I think back to this thought about megatrends, I think the shift to digitalization of our lives and the need to store that information and to have places where the compute power is done, where those NVIDIA chips come together, is super important in the United States, in Europe, and in Asia. It has developed a little more slowly in Asia, but we're seeing it accelerate. We spent a lot of time thinking about, could we build a platform fully from scratch? And we concluded that we would be better served if we bought an existing platform that had a world-class management team, in this case, the founder, super talented, had a large bank of sites, also access to power, which is really important. It's the constraining factor, and footprints, in this case, in Japan, Australia, Singapore, Malaysia, a little bit in Hong Kong as well, and then the opportunity potentially to go to Korea, to go to India. And so we did make a decision here to acquire this $16 billion business, and it's based on this high conviction view. Interestingly, the tenants are pretty much the same 4 or 5 tenants that are powering what's happening in the US in data centers, the biggest technology companies in the world who are making an enormous bet, who are spending hundreds of billions of dollars together in CapEx every year to build out their footprint. And I think it's exciting, and I think you're making essentially a derivative bet on a bunch of things, but obviously AI in particular. And oftentimes there are ways to make money besides just investing in the theme itself. So it's a little bit of selling the picks and shovels to the miners who are looking for gold. In this case, what you're doing is you're betting on providing this infrastructure to the people who are doing the most innovative technology in the world.
Now, you've said earlier amongst the various investment themes, real estate seems to be bottoming out. Prices are near levels that we've seen in the great financial crisis and other low points. Is this really the time to lean into real estate? And is that universally true globally or selectively across certain markets?
I think it's pretty similar around the world. I'd say the Chinese real estate market's in a different spot. But in most markets around the world, you had 2 things that fundamentally happened. One was in the office sector, because of COVID, you've seen a very sharp decline in office usage. Less so here in Korea and Japan, but certainly in the US and parts of Western Europe, Australia. That has led to very high levels of vacancy in the office sector, as high as 25%, and their value declines have been significant, and it's going to take some time to get out. In the other classes of real estate, particularly where we as Blackstone have focused, the fundamentals have been much healthier. So vacancy in rental housing or logistics in most markets around the world is 5-6%. So it hasn't been that you've seen a sharp decline in cash flows. What you saw was this rise in cost of capital. Interest rates went up, borrowing costs went up, and that put pressure on values. The reason why in January we said real estate's bottoming is because we started to see the 10-year come down. We saw the inflation numbers improving. You could see that we were going to start to head towards easing. Spreads started to tighten for all sorts of real estate debt, as well as corporate debt. And the commercial mortgage-backed securities market, public real estate debt, reopened. It's up 4-fold this year. And so the cost of capital came down to buy and finance real estate, and that can help support the values. And the hard part for investors is you're often waiting for this all clear sign, right? And the problem is, if you went back to the financial crisis back in 2009, that's when you wanted to start investing in commercial real estate. Now, for the next 3 years, there were all sorts of bad headlines about real estate deals that were made in the past that had too much leverage and got in trouble. And if you waited for all that to work its way through the system, you started investing in 2013, you missed the best investment period. So again, you're going to keep reading about troubled deals that were done. Somebody financed an office building back in 2021. That loss, now shows up. But that sort of happened. It's a little bit like a storm that happens, and then all the things that come after the storm, you see. But the storm, for the most part, is past. And as investors, when you're at this moment of uncertainty in terms of headlines, but the fundamentals are actually okay, people are building a lot less commercial real estate, which is helpful, cost of capital has come down, that's when you lean in. And we as a firm have deployed 2.5 times more money this year than we did last year, done a number of large privatizations in the US, done a bunch in Europe. We're working on a number of things in Asia, including in Korea. So I think it's pretty global. I think most people are going to be cautious. They look at their old real estate deals. They say, oh, I don't feel really good. I'm going to wait till I work through that. And unfortunately, that can mean you miss the best opportunities.
Now, just to shift gears for a moment, in the broader context, we obviously live in the alternative assets world, and there's growing interest in this area. What do you think is causing that? Why is that so exciting?
So private assets, if you went back in time, were a pretty niche business. If you went back 10 or 15 years ago, we had a relatively small number of customers, pension funds, sovereign wealth funds, endowments. And we basically did three things. We did private equity, real estate private equity, sort of high-octane real estate, and distressed debt or opportunistic debt. You were trying to produce 15% net returns for your customers, and that was the world. After the financial crisis, when rates came down a lot, investors became more open to doing private investing in alternatives, not just at the highest return strategies. Could you get me a 10% return in infrastructure or core plus real estate? Could you get me a couple hundred basis points higher return in performing private credit over liquid private credit? And what that meant was we started expanding the activities we did, and we've really been the leader in this business. But we also broadened the number of customers. So many more institutions became open to talking with us about some of these other, I'll call it lower risk, longer duration strategies. We found individual investors where we created products where individual investors could invest in private real estate, private credit, private equity. And then we started talking to insurance companies, we and some of our competitors, about investing in performing investment grade credit. And as a result, the total addressable market, or TAM as people talked about, in our industry has grown dramatically. And so what you saw is a very limited business, limited number of customers, to now something that's much, much larger. And if you want just some perspective, our institutional pension fund clients generally are about a third allocated to private assets. If you look at individual investors, even high net worth individual investors, they're 1% to 2% allocated. So as we create structures, these semi-liquid structures designed for individual investors, around the world we're finding receptivity to that, and we've seen enormous growth. And a similar dynamic with private credit for insurance companies. So I think people think this is all about, oh, it's just private equity, but it's actually a really broadening of what we're doing. And for us as a firm, what it allows us to do is now become a full service capital solution provider where we can provide high octane control, buy a business, all the way to the most senior capital from one of our insurance clients where we're providing investment grade credit very attractively, let's say to project finance, and it gives us more data points and insights in what's happening around the globe. And it makes us even, the global opportunities greater, both for raising capital, but also for investing it.
Fantastic. Now, John, this is your 4th trip to Asia already this year. You've got a few more planned. Why is Asia so important? Why are you out here so often?
Because I love not getting sleep. It's funny. I think we just look at the world and we say, here's where, roughly 40% of the globe's GDP sits, well more than half of the growth in GDP, and yet alternatives are still in their early stages, both from the range of clients, as well as just investing in many of these countries. And what we have been doing, as you know well, is moving from, I'll call it sort of a hub and spoke model. If you think about the way we operate the business in the US, it's mostly New York, few people outside of New York, mostly London covering Europe. But in Asia, over the last decade, we've really figured out we've got to become local. So have Korean teams in real estate and private equity, same thing in Australia, in China, in Japan, in India, Singapore, build up our capabilities. So part of this is spending time with the teams. Often we have some newer people with us. Part of it is seeing our customers. And then part of it is seeing opportunities and saying, hey, look, how can we do more? The conversation you and I had this morning, which is how can we advance what we're doing? Are there more privatization opportunities here? Are there more non-core businesses we can buy? I just think if we spend more time in this really important and fast-growing part of the world, more opportunities will emerge. And that's what we're focused on.
And in that context, what's Blackstone, in your view, on Korea, on this market?
So we really like Korea. I mean, it's a place where there's good transparency, rule of law, obviously very talented, hardworking people, incredible capabilities around manufacturing and high technology. As companies are diversifying supply chains, I think Korea obviously is a beneficiary of that. A long time, of course, U.S. ally as well. There's just a very good foundational business environment here. And, when I look at Korea and I say, where are we focused? In real estate, it's areas like hospitality, hotels. People love to come and visit Seoul. It's areas like logistics, as I talked about, because of the rise of e-commerce, certainly data centers. In your world, in private equity, healthcare, obviously the demographics here are aging. We had a lot of success with the healthcare services business here. We're looking for other opportunities, of course. Advanced manufacturing, obviously. Everything that goes into the supply chain around semis becomes more and more interesting because we're going to need a lot more semis, and there are a lot of businesses that support that. I just think there are a lot of very interesting businesses that can be, export champions, and with our additional capital, maybe some expertise, we can help these businesses grow. And I do think one of the misnomers of sort of private equity is this idea that you're going to buy companies and you're somehow stripping them down, taking out tons of costs, and that's how you're going to make money. But the reality is, to generate high returns in private equity, you have to grow the businesses. So we have to find a company here that's strong domestically, and then figure out how can we grow them regionally or globally, give them capital, augment their management team. That's the way we're going to generate really high returns, and we've done that around the world. And I think the opportunity set here is going to grow, and I think the more openness there is to foreign investment, the more openness from big companies to bring in partners to non-core divisions, the more openness there is from boards for privatizations, that will create a flywheel of investment activity, and you'll see more and more of Blackstone investing here.
Excellent. John, thank you so much for being here today. Thank you.
Thank you all.